This is Elliott Wave Cafe. I'm your host, The Cowboy. It is Monday, April 18th, and welcome to another episode of the Chart of the Day. Let's get started, guys. All right, so we're taking a look here at the SP 500. I've done a video on this maybe about a month ago or so, and I want to kind of revisit this, and I want to show you a few interesting things. So today it's been a weaker day in the markets, pretty much, I guess, closing flat or something like that. But I wanted you to take a look at this longer term perspective that I have in here, and this is going back to 2008 lows, where I'm looking at this as a second wave pullback. Now I have a count that shows this as a fourth, and that's more of a bearish count, and I'll get to that in a second. But let's assume this is a second wave and we're continuing to grow and we're continuing to follow earnings, and we are in a secular, let's say, bull market that should continue to move much higher. So for that to be the case, I gotta start having some subdivisions into the sequence in here where I have a lower degree count on another 1-2 formation. And the biggest correction that we've had in this advance is back here, where you kind of dropped first, then you went back up higher, and then you sold off in this expanded flat formation. This creates a secondary a wave 2 at the smaller degree of trend. So you go in a 1, 2, 3, 4, and 5 for 1. Then you sell down in 2, and then you begin the larger advance upwards. So we're on the side, kind of nice trending channel. We broke above it. We kind of come back below. But I want you to draw your attention to kind of what starts to happen back in here. And the big question is, we've been selling off here. We have tightening monetary policy supposedly coming up from the Fed in here. We have high inflation numbers. There is some economic data that's kind of mixed. I mean, you have good things happening and some bad things. You have an unemployment rate that's very low. That's usually kind of precedes recessions. You have a yield curve that actually inverted not that long ago. Is kind of back to steepening. So there are plenty of reasons to be bearish, and maybe some reasons here to continue to stay bullish, especially that you're on an uptrending market in here. So the question is, what's going on here at the smaller time frames? Can we digest and find out what's happening? So I have here a couple of interpretations. One, it's a fourth wave. So I'm looking at the 1, 2, 3, 4, and then another push up higher here in a fifth wave. That would complete a wave 1, at the lower degree. So let's say that this is intermediate, right? The next degree would be here a minor degree. So you go in a 1 and then back in 2, and then you continue to push higher. And then you can see it in here as well. You can hear it. You can see it in here as well in this kind of red. In case this fourth wave was done a little bit earlier, then you go in a 1, 2, 3, 4, and 5. You have a wave 1 done, and then you sell lower, at this minute degree. So let's dive down into the smaller time frame. So to the next slide, I'm looking here at the 2-day chart. So here you have, the 1, 2 that you saw in there, another 1, 2, let's say a larger third wave, and then a possible fourth wave triangle developing, with the alternate that this wave 4 has already been completed through this decline, and we can actually move to the upside already in another 1, 2 out of here, and then 3, 4, and 5, and make new all-time highs in the S&P 500. And that is a question that it's on my mind here, because I'm looking at the time fib in here as well, as the S&P 500 traveled on this decline, on this kind of corrective move. It already passed 161.8 multiple of distance travel in this wave 2, and this kind of concerns me into the idea that this would extend so much as a fourth wave in here, go towards 400% more in time travel than a secondary wave. And then every time I kind of start to pass 200%, I'm starting to think, well, it's probably not a fourth wave. And that's why, I'm doing this as an alternate wave 1. And I think this here is incorrect. I have to change the degree to a minor degree. This is a minute. So it would be a minor degree wave 1. And then you develop in some sort of a second wave in here, where maybe this becomes something totally different. Let's say this is a the beginning of a correction in here. Maybe it's a wave W, you're getting maybe an X wave, and then you're going to get a larger Y wave, something like that. But you might get some type of a flat if this move continues higher in here and then pulls back lower. But the idea is that it would continue to extend lower and become much larger than anything that happened back there. So that's why I'm kind of keeping an eye on the market right here. I think near term, this pullback in here should resume to the upside. So you're having this, short of this being an ABC for a B, then you're getting an A. You're still probably going to get a B wave and then another C lower and then push back up and so on and so forth. So I think there's a little bit of a bounce coming in the equities. We'll see how far that's going to travel. But, guys, listen, the point is, we are in a very kind of sideways choppy market. And, there is not a lot of direction that you can just pull from here just yet. Once you kind of finished an impulsive move, when you start moving into the corrections, things start to get very choppy, and there's not a lot of things that, that can be exciting for necessarily impulsive trades. So the most exciting thing that could happen here is that this was a wave 1 and this is a wave 2. And then you're starting to do a 3, a 4, and a 5 and actually push to the upside, right? But we have a little bit of an issue back into this decline. So let me show you here as well. The moving averages were basically below the 200, below the 50, below the 21. The moment you lost the 200-day moving average, you basically lost the uptrend in here, and you're starting to go sideways. There is a mixed bag of a lot of things that can happen back here. So there is nothing really encouraging in this market. I wish I could come out here and say, man, I'm really, really bullish on here. Things will explode higher, but it's still very, very messy. I want to see this market kind of regain this footing back there and try to climb back above that, trying to climb back above that resistance. And then we can say with a little bit more certainty that this market could rally, right? Short of some kind of a flat move in a B wave and then another C wave decline, and only then you go, right? So that's the risk when you move to new highs, especially after you start with the correction here, possible of a second wave. But I wanted to kind of draw this attention to you that every time you're below these moving averages, you're losing that kind of bullish sentiment, and people start to be a little bit more fearful when you're back below the 50, back below the 200-day moving average. You're very familiar with that. So here is the bearish count, right? That looks at the 2-week chart back 1977, maybe a secondary wave in here, a larger third. So a big, running, let's say, super cycle move here in this larger third wave, then a fourth wave in here, pullback in 2008 recession and the Great Recession. And then you're starting a 1, 2, 3, 4, and 5, and you're about to finish maybe this much, much larger sequence. So this is the scariest count of them all. I talk about this all the time. I talk about this in the program too. It's something that we have to watch. I don't think this is going to pan out. I mean, something, again, extremely bad has to happen in the economy for this thing to, or around the globe for this thing to kind of start selling off and coming back all the way back here towards, let's say, at least, 2,500 in here into the SP 500. And then, if it's even larger, then all the way back here, imagine what that would mean for United States economy. And I don't think that the Federal Reserve will stay nicely by and let these things kind of happen like that. So I have my doubts when it comes to that. So let's jump over to take a look at the next one. So the next one here shows you basically the earnings into the S&P 500, and we've basically started a new season of earnings. And you can look at the red line in here that it shows, how much we have where the stocks would be overvalued. Where you have basically 20 times earnings for the S&P 500, where you have 15 time earnings. What's the value of the S&P 500 at 15, and that what it is at about 10 of the companies that report earnings. And you can see in here that we've been pretty overvalued for a while, right? We're way over this line, 39.56. The market was pretty hot following the pandemic in here with all the stimulus we've gotten, and it's been cooling off ever since. So, slowly we're coming back into some value here. And the first level of that value would be around 39.56. We'll see what the companies are reporting in here, and how this earnings season will unfold. But, normally, short of a recession where companies lose money and you're, everybody's in trouble, you're expecting these earnings to continue to grow and move higher. And stock market, usually, trades with that. So what I'm watching here is either for earnings to kind of catch up to the S&P 500 or the S&P 500 sell off to more, normal valuation levels. I mean, to kind of come back towards 15p, that would be, quite a bit of a stretch, quite a bit of a big sell off. And then if you're going, back here to 10, right, that would be something very, very aggressive. I don't think that the markets have ever kind of reached such a deep level. Usually even in the, Great Recession here, you came back towards, 15 PE. And then all of a sudden you kind of started to rally. And then back here, you came back towards, more towards 20. You sold off in here along with the earnings, right, as well. And that earnings actually continued to fall, right? But due to the stimulus and the fiscal monetary policy and all that, stocks actually started to rally, and then the company started to catch up, with the S&P 500, with the index. So pay attention to this one. It's important to kind of know what the earnings are and what the earnings do, because stocks follow earnings, and usually they continue to grow, which means that the stock market moves higher over time. The next one that I wanted to show you here, it's a little bit of a breadth indicator that kind of shows you, where we are with the S&P 500 in relationship with the percentage of stocks that are above their 200-day moving average. And right now, only about 48% of stocks are above their 200-day, which means that about 52 are below. So it's a very split market, half and half, and it's kind of hard to have solid rallies when you have a market that's basically kind of split. You really want it to, get at least above 60, 75% of stocks to be above their 200 moving average, so everybody can participate in this rally and create a better, for the market to have a better reason to push to the upside, right? Those companies have to climb above their 200-day, and so far we're somewhere in the middle of that. That's why maybe we have such a choppy price action. But you can see in here we're kind of following this very, very closely. And if you look in the past, you've spent a long time here from November 2021, all the way to July, August 2022, where the percentage of stocks above 200-day moving average was at about 85%, 90%. And then you're starting to get a little bit of a divergence in price. You notice how, the percentage of those stocks started to push lower, and the S&P 500 was moving higher, sending a signal to the market that something is weak underneath the surface, and not everybody is participating, and stocks are actually starting to lose value. And most of those stocks were in the technology sector. And sure enough, then you had a bigger sell-off kind of following through. Then, the rest of the stocks starting to sell off, and more stocks ended being below their 200-day moving average. Up until, let's say, February, maybe beginning of March, when we kind of started to stabilize, and, the S&P 500 was moving lower, but the breadth was actually starting to move higher here a little bit. And it was, this is actually seen better in the NASDAQ. If you look at the breadth in the NASDAQ, you'll see that a little bit better, that those stocks that were above their 50-day moving average actually started to rally. And more stocks started to rally above their 50-day moving average, and the NASDAQ was actually making a low. So there was a signal saying that be careful, we should get a pretty strong rally. And it came soon after, with the NASDAQ here rallying strongly, and the S&P 500. So right now we're back towards, there's not really a lot to say about where we are right now. So I'm waiting to see if this is going to push higher, while for example, if the S&P 500 sells lower and this breadth indicator moves higher, that's going to be a positive thing. And here is the one that shows you the 50-day moving average. So you can see back in here how look at the purple line as it was stabilizing and actually moving higher a little bit in here, while the S&P 500 was actually dropping lower. And then it led to a subsequent rally that was pretty strong, one of the best rallies we've had in a long time. So it's a good indicator, especially when it comes to divergences and things like that. So I'm watching this with the members as well, because it's something that kind of tells you what when you're getting too weaker, when you're getting weak, when you're getting maybe ahead of yourself, when the stocks get too frothy and everybody kind of participates, and so it's definitely something to watch. So the next slide I have, it refers to basically the AAII index here. So what this is basically, so this is American Association of Individual Investors. You're probably familiar with this, with this association in here. And, I'm following this. It's not kind of one of my primary things, but every time I'm noticing big sell-offs, I want to see kind of what the sentiment is. I go to this indicator and I check it out. And this updates every Wednesday. So, in a couple of days here, it will update and we'll find out, what the sentiment is, if it actually recovered a little bit more towards the bullish side, or if it continues to be bearish. But basically on the green line here, you have the bulls, and then on the red line, on the red histogram here, you have the bears. And the question basically that gets asked here every single week is what direction do AAI members feel that the stock market will be in the next 6 months? And they have to respond. They send the survey out, and people respond, and then that gets plotted here into this indicator. So you can notice in here that we're getting, to some extreme readings, and this is the spread between the two. So if you're taking minus 48 plus 15, you're ending up with this kind of minus 32 in favor of the bears. So, and this hasn't been such a low levels since about 2012, 2013. And it's pretty bad out there in terms of sentiment and kind of how people feel. Even after you've kind of had this rally higher, people don't believe this. They believe that this is probably a fake rally, that we're going to sell lower. The sentiment is deteriorating. So almost nobody is bullish in here. People are kind of afraid that we're going to break to the downside. So this is an interesting indicator to kind of look at. And if everybody is really so bearish, then what's happening in here? Could we actually take it as a kind of a counter trend indicator? I mean, you've had a little bit of a, bearishness in here, as well as we were kind of climbing up. People continue to be bearish, but then they kind of got squeezed out back into bullish. Then they've gotten way too bullish back here. And as the market continued to climb, right, people were getting, the sentiment was getting less and less bullish, but still pretty bullish, right? So still pretty elevated. But this was also kind of divergence that it showed in here, that something could happen. So if you can kind of combine that with some of the breadth indicator, there were some signals here from this market. So anyway, I'm watching this. This is kind of also climbing a little bit in here. You have a little bit of a divergence here in the market, but not enough just yet. So, if the market will start to sell off and this red line will start to kind of climb up, let's say over the next few weeks, then, that could be a signal that, there might be a larger rally coming. So keep an eye on that, because it's pretty interesting as well. So I just kind of wanted to show you that. And then, the next one that I have is basically, I'm going to kind of close off with this. But before I do, guys, don't forget to subscribe and like. It's very important. I know people at the end of the video, they get distracted, they hit the stop button and they move on. But since I still got your attention, if you've managed to kind of stay with me so far, don't forget to subscribe and like, so we can continue to rise in the YouTube rankings in there. And thanks for everybody that's subscribing and participating to these videos, and leave comments, let me know what you think about this series. But I wanted to kind of show you, this ratio between the high yield corporate bonds, which is this HYG. So this is the ETF that kind of tracks that. And then I'm looking at the TLT, which is a treasury bond ETF. It's about a 20-year. So it's a long-term bond ETF. And basically the dotted line in here is the spread between the two. When this line is moving higher, people are getting excited and buying more corporate bonds than treasury bonds. Now, when people buy treasury bonds, more than they buy corporate bonds, this line is getting lower and people are more fearful, and they basically run to the safety of the longer term bond in the treasury market, right? And that usually signals a risk off in the market. But when they actually buy high yield corporate bonds, right, this is more of a riskier bond, right, because they give you higher yields, and maybe they're not as and you can look at the ratio of the junk bonds as well. Maybe they're not as stable, as strong as the United States Treasury bonds. So what this line here basically shows you is there's still a very high appetite for risk in the high yield corporate bond market, right? And it's a pretty good indicator because, if you look in the past and you kind of studied as this continued to grow, the stock market kind of continued to follow. And actually back here, you sold off a little bit into the SP 500 back in, March, April 2021. But this indicator was telling you, I don't think so. I think we're still kind of pushing higher, right? And the market continued to move as well, up until this point where, we've kind of hit a top into the spread, and then we started to sell off, let's say May, June 2021, and the market kind of continued to climb a little bit in here. So this showed the divergence, and then it was followed here by a little bit of a sell-off, right, from September to November 2021. The market kind of caught up with this indicator, and then this one sold off even more, right? So you started to have a market that was pushing higher, but people were starting to actually buy treasury bonds more than they were buying high-yield corporate bonds. And this was something that was starting to scream to you that there might be a bigger sell-off. So as the market was making new highs in here, right when they kind of hit the lows, the S&P 500 pushed back one more time. This indicator kind of started to stabilize, but the market actually sold off and kind of caught up with it. So it basically signals alarms in here that, there's not, as this one kind of sells off, even though it looks like an ABC correction, it signals that, there's not a lot of excitement about the market, and you kind of have to be cautious back here. And so we sold off, and now we're kind of stagnant in here, right? This ratio moves higher, makes new highs, but the S&P 500 is pushing lower. And it's not responding to what's happening in the corporate bond market. So now this is interesting. Is this, people are buying this just because of the yield or just because of the inflation, or what's going on? But definitely you're not necessarily seeing as a risk-off indicator from this particular metric that I'm watching in here. So S&P 500 moves lower, this thing moves higher, and I tend to think that bond market, it's the one that's usually more correct than the stock market, and maybe this is a signal here that the market will probably stabilize in here and push higher. And another thing I wanted to say, right, we're going to have the Federal Reserve meet next month. And, we'll see how much they raise and kind of what's their guidance moving forward. But one of the biggest surprises would be if they only raise 25 basis points instead of 50. If they note all kind of other risk in the economy, or the increase in commodity prices or whatever they can come up with, right, to justify maybe only a 25 basis points instead of a 50, that would be a big surprise, and the market could continue to rally much, much higher. So pay attention to that. I'm going to, talk a little bit about in some future videos about the yield curve. I have a lot of other kind of ratio spreads that talk about, risk sentiment and kind of what's working, what's not working, and I can dive a little bit more into that, just to kind of make this videos a little bit more comprehensive, not just necessarily strict to Elliott wave presentation, although I do like that, and I wanted to kind of show that as much as I can. But again, thanks for watching, and I'll be talking to you on the next one. Bye-bye.